So let's start with a big question. What if the entire foundation of modern finance, all of it, is built on an idea that's beautiful, elegant, and maybe, just maybe, completely flawed? Welcome to The Explainer. Today, we're diving deep into one of the most powerful ideas in all of finance. We're going to ask, are financial markets these, elegant machines of pure logic, just perfectly processing every bit of information? Or are they actually built on a foundation of fragility, constantly teetering on the edge of total chaos? All right, so to get our heads around this, let's start with the theory in its purest form. We're talking about the efficient market hypothesis, or as you'll often hear it, the EMH. Okay, so at its very core, the EMH, and this was really championed by the economist Eugene Fama, suggests that the stock market is basically like a hyper-efficient supercomputer, right? Any new piece of information, whether it's an earnings report or just a news headline, gets instantly absorbed and the price, poof, adjusts perfectly. What that really means is there are no hidden bargains, no overpriced traps. The price you see is, in theory, always the correct price.
Now, what's really interesting is that this theory isn't some one-size-fits-all deal. It actually comes in 3 different flavors, or strengths. First, you've got the weak form, which basically says studying old price charts? Yeah, that's useless. Then there's the semi-strong form. This one goes even further. It says even if you're the best analyst on the planet, reading every single financial report won't give you an edge. And finally, you get to the strong form, which is, wow, it's the most radical of all. It claims that even insiders with secret, juicy info can't consistently beat the market. Crazy, right?
But, and there's always a but, isn't there? This beautiful, elegant machine has a catch, a big one. It's a logical paradox that really questions its entire foundation. Let's call it the first big flaw. Yeah, just think about it for a second. If markets are perfectly efficient and every price instantly reflects all the available information, well, why would anyone bother paying to go out and get that information, right? There's absolutely no reward for all that effort. This right here, this is what's known as the Grossman-Stiglitz paradox, and it's brilliant. Think of it like a treasure hunt, okay? If everyone knew for a fact there was zero treasure buried on the island, well, nobody would bother digging, right? But the only way to know for sure there's no treasure is for people to keep digging. It's the same with the market. The market only gets efficient because tons of smart people are constantly betting that it's inefficient. So perfect efficiency, it's like a finish line you can never actually cross. Okay, so that's the first crack in the armor. Let's move on to our first major breakdown and see how this all builds. See, the theory assumes that we're all perfectly rational investors, little profit-seeking robots. But what happens when you introduce the human glitch? Yeah, so classical finance is totally built on this idea of the rational economic agent, this flawless, profit-maximizing computer in human form. But then behavioral finance comes along and introduces us to the actual human investor. And that person, well, they're swayed by emotions, brittled with biases, and they love taking mental shortcuts. And here's the thing, these psychological glitches, they aren't random. They're predictable. They're systematic. We all suffer from loss aversion. That feeling we're losing $100 hurts way more than winning $100 feels good. We all do it. We exhibit herd behavior, right? Following the crowd because it feels safe. And oh boy, are we often guilty of overconfidence, thinking we're smarter than the average investor. I mean, think about the dot-com bubble. That was a perfect storm of herd behavior and overconfidence, a collective delusion that had almost nothing to do with rational analysis. This quote just nails it, doesn't it? Feeling the pain of a loss twice as acutely as the pleasure of a gain, that's not rational, not at all. But man, is it deeply human. And it makes us do completely irrational things, like holding on to a losing stock way too long, just hoping it'll come back, because we can't stand the idea of locking in that painful loss. And look, these biases aren't just theoretical. They create real, measurable weirdnesses in the market, anomalies. A great example is the momentum effect. It shows that stocks that have been winners in the past tend to, well, keep winning, at least for a while. Now, this directly contradicts even the weak form of the EMH, which says past prices can't predict future ones. And what's driving this? It's all human psychology. We underreact to news at first, and then we overreact as a hurt. It's like a ghost in the otherwise perfect machine. But okay, the problem goes even deeper than our own quirky psychology. It's actually embedded in the very nature of risk and reality itself.
And that leads us to our second big breakdown, the unknowable event.
This idea was really popularized by the philosopher and trader Nassim Nicholas Taleb. A black swan? It's the ultimate unknown. It's not just an event that surprises us, it's an event we didn't even know was possible. I mean, think about the 2008 financial crisis, or the global pandemic. Our spreadsheets, our fancy models, they had absolutely no column for global system shutdown. There was no room for these things, until, of course, they happened.
So a true black swan has three core features. First, it's got to be an extreme rarity, an outlier. Second, it has a massive, often catastrophic impact. And third, and this is the sneaky part, after it happens, we all look back and rationalize it. We use hindsight bias to convince ourselves, oh yeah, we should have seen that coming. It was predictable all along.
And Taleb really takes aim at the standard risk models that banks use, like value at risk, or VAR. He calls it the great intellectual fraud. And why? Because it creates this dangerous, false sense of security. It looks at historical data to predict future risk, but by definition, historical data excludes these extreme, unprecedented events that have never happened before. So here's the critical point, right? The mathematical tools of traditional finance, they're all built for a nice, predictable bell curve world, a world he calls mediocristan. But our financial markets, they often operate in what he calls extremistan, a place where one single outlier event can change everything. And in that world, these models aren't just inaccurate, their failure actually becomes a direct cause of the system's fragility.
Okay, so if the old models are fragile and perfect efficiency is pretty much an illusion, then what do we do? How do we build a system that can actually withstand the unknown? Well, this brings us to a whole new paradigm.
The focus has to shift completely. We move from prediction to preparation. So instead of trying to forecast the next crisis, which is impossible, we should be building systems that are anti-fragile. That's another great term from Taleb. It doesn't just mean robust or resilient. It means systems that can actually benefit from shocks and chaos. And how do you do that? You prioritize simplicity over insane complexity. You avoid the illusion that you can calculate every single risk. And most importantly, you limit your exposure to those catastrophic wipeout losses.
And this really brings us to a fundamental trade-off, doesn't it? To get that long-term systemic resilience, we probably have to sacrifice some of that short-term market efficiency. Think about it. Being perfectly optimized for today's calm, sunny weather is great, right up until you're hit by tomorrow's unforeseen hurricane. Then, that optimization makes you incredibly vulnerable.
And so, that leaves us with one last really crucial question to think about. The efficient market hypothesis, it gave us this beautiful, elegant blueprint for a perfectly optimized world. But in the real world, a world that's defined by our own biases and unpredictable chaos, what should the ultimate goal even be? Is it efficiency? Or is it just survival?